Now we'll head on to the personal finance tip segment of the week. It's pretty basic, and well, they're supposed to be basic, but we want to talk about the basics of company sponsored retirement plans. The most important of them being the
401k plan.
401k. That's the most ubiquitous, the one we see the most often.
What most people are aware of or hear about or participate in their company.
Correct. Maybe in for certain segments of public service, you have a 403b, but 401k is by far the most popular. So, Jerry, what should they know about the 401k?
Well, I mean, they should participate in it, and
I think there you go. Okay, right. And that actually could be in a lot of ways. That could be enough said.
That could be enough said.
Yep.
At the very least, most company 401k plans will have a component where the company will match, and the most common number I see is like they'll match up to 4%. So if you contribute 4% of your salary, your income, they'll match 4%. Now I think the numbers they've gone up over the years. I think it's up to 25% of your income that can now go into a 401k. And there are limits based on how much money you make.
It's a significantly higher limit than an IRA.
Yes.
So depending
significantly
on how much you make.
higher.
Yep.
Yes. And so in most cases, at the very least, people should participate to the extent that the company's going to match, because that's just free money. And, we hear a lot about the problems with Social Security, and they're myriad, but like, for example, if the money that people quote unquote put into Social Security, which is not really what's happening, it's a pay as you go system, and they're taking your money and giving it to someone else. And in the years when they were taking more money from people than they were giving, and there was supposed to be a trust fund, though they spent it. That's another discussion. But it is. Sorry, Doug, I accidentally made a noise. Not to get in a big discussion about Social Security, but if people had been able to put their money that they paid into the Social Security system, or they were taxed, it's a tax. The Social Security tax, put it into a plan similar to a 401k, oh my gosh, we would not have a Social Security problem at all. It would be just if it was put in any kind of reasonable, investment account over the years, we'd be actually in really good shape. In fact, that's one of the great arguments, I think, for how we can reform Social Security, is turn it into a true defined contribution plan instead of a defined benefit plan. But the 401k is one of the best tools people can use, and for saving for their retirement, saving for the future. It's it grows tax deferred, and it's taken out of your salary tax pre-tax. So it's taxed when it comes out. And there are points where you cross over, and some people maybe have more in that than they should, but that's getting really nuanced. And for the average person, that's not the issue. The issue is, this is a way for you to save. I mean, there's a lot of people, and we talked the other day about my favorite savings and investment plan, and I said that was over and above your retirement plans at work, and it should, and it is. And you should still absolutely be doing that. But for many people who don't do that, participation in the 401k plan, a company-sponsored retirement plan, is truly the only savings they ever have, or the only kind of investment savings plan they have. So at the very least, the bare minimum, people who are working for a company that does sponsor, and there's very few companies nowadays that don't sponsor some sort of retirement plan, especially if it's a company of any size, they absolutely should participate in that. It's a no-brainer, and even more so to the extent that they participate when the employer is matching, at least. So put the amount in that the employer will match. They put $1, you put $1 in, they put $1 in. It's a double. I mean, it's pretty hard to double your money immediately in any investment. So you put in the power of investing over time with the fact that the company's participating and giving you money on your behalf. It's a win-win.
I would say this is one of the few things in investing that is almost do first and then ask questions later.
Absolutely.
Because you're doing two very powerful things. You're always getting the money out of your own hand, which is a good thing. for Americans. And as an American, I can vouch for that. And number
Yep.
two, you're generally getting some kind of match on it. So even
Almost always.
it almost makes the investment selection secondary, whether it's, cash, bond, an index fund, target fund, or something like that. That the power of getting out of your own hands and getting a match is so great that don't think about this, don't put it off. And that's why the reason why you've seen companies more and more almost have it be a default. You have to opt out of the 401k for some companies. They almost take the Big Brother-esque stance of almost opting you in unless you opt out, which, as far as bad things the government can do, that's actually pretty low on the list. So obviously we don't want to get too much into
It's a simple way of helping yourself.
All right.